Stephen Myron came out recently talking about that third mandate, which is sort of, it is, part of the Federal Reserve statute, but we typically think about the Fed's mandate in terms of its dual mandate of inflation and unemployment, but that is part of what they're chartered to do. So when we say moderate long term interest rates, yeah, there's a lot of wiggle room around there, and there's a lot of in my opinion fairly legitimate criticism around the Fed and the extent of their role, and we've had this whole period pre-pandemic with QE and buying MBS, which obviously is was beneficial for our industry for a long time, but now we're sort of feeling the drawdown of that. And whether it makes sense for the Fed to get into these other areas. But what's interesting about it to me, and I know I mentioned to you guys, I recently finished a book called The Price of Time, which came out a couple years ago, and that's by Edward Chancellor. I found it pretty interesting. It's a little dry. We'll talk about the history of interest rates, but kind of fast forward to a lot of the 20th century and getting into the 21st century, a lot of the criticism is around the risks of keeping interest rates too low and what that does to the economy and how that sort of distorts investment, causes asset bubbles, a lot of things that we're sort of familiar with if we're watching the markets closely. And one of the arguments that it made also was in the run up, in the post.com boom bust, there was kind of a lot of pressure on the Federal Reserve to keep interest rates low, and that pushed a lot of investment out into higher yield, more risky investments, and was one component of setting the stage for ultimately the Great Recession.